Good morning. I want to thank everyone for being with us today, and we want to take a look, I think it's very appropriate, at the trend of smaller companies now exploring self-insurance as a very viable option to provide their employees with health care coverage. And I appreciate all of our witnesses taking time out of their busy schedules to be with us today. Just last week, President Obama apologized to the 4.8 million Americans who had their insurance policies canceled since his health care law was enacted. This includes 137,000 people in my area of Western New York. And while I appreciate the President's apology, these cancellations represent just one of the many broken promises and severe problems plaguing the rollout of his signature legislation. The list of issues with this implementation is staggering. The bungling of the healthcare.gov website, the 30-hour per week definition of full-time employment, the medical device tax, the health insurance tax, the cancellation of policies, and of large concern to those of us who serve on this committee, small businesses facing significant increases in the cost of their health care plans, upwards of 55–60% in many cases. These are not issues that the President and the administration will be able to resolve anytime soon. So as the confusion continues, small businesses and the people they employ continue to be left in the dark about what January 1st, 2014 will mean for them, their health care needs, and the costs. The subject of today's hearing is certainly not a magic elixir that can solve all of these problems for every small business, but it could be a viable option. Amid all of this confusion, small firms need as many options as they can find to keep their businesses moving forward, make money so they can invest in the growth of their companies. In a self-insured situation, an employer can choose to assume all or a portion of the cost and the risks associated with sponsoring a health care plan. Under this arrangement, the employer forecasts how much it is likely to spend on health benefits. It's usually an actuarial calculation, and then decides whether or not it makes practical or economic sense for that employer to pay these costs out of pocket or to purchase a fully insured product. Traditionally, small businesses have not utilized the option to self-insure. According to the Kaiser Foundation, only about 16% of employees at small firms are currently covered by a self-insured policy, as opposed to nearly 83% of employees at large firms. But with the onslaught of regulations, cost increases, and uncertainty surrounding fully insured plans as a result of the President's health care law, more small businesses may choose to explore self-insurance as a manner of providing competitive benefit packages for their employees. Some small business owners may find that a self-insured policy would be cheaper, as it may offer them greater flexibility in designing the health coverage they want to provide for their employees. With that said, there are some potential disadvantages as well, such as the instances of higher than expected employee claims and additional administrative costs that could discourage smaller firms from utilizing the self-insured plans. We're not here today to advocate one method over the other, but rather we're here to examine if self-insurance is a viable solution for some businesses. When we say if, it really is, but that's what we're going to cover today. And so we ought to continue to preserve that option for small businesses, especially considering the uncertainty surrounding the fully insured marketplace as Obamacare continues to be implemented. Again, I want to thank everyone for being here today. I look forward to the testimony. And before we do that, I want to yield to Ranking Member Hahn for her opening statement.
Thank you, Mr. Chairman. And I'm pleased that we're holding this hearing today. And the Affordable Care Act introduced many substantial changes to health care, and these reforms will improve access to and adequacy of coverage, allowing young people to stay on their parents' insurance, expanding Medicaid, and not denying coverage as a result of a pre-existing condition. And, you know, California knows how to do things right.
Really?
Yes, we've already had 59,000 enrollees in covered California. So we're ahead of the nation in terms of having our website working and people actually going online and getting good plans, affordable plans. So we're very proud of what we're doing in California. The small business exchanges will offer opportunities for small businesses to provide quality health insurance to their employees. At the same time, self-insurance or self-funding could be an option for small businesses to offer insurance coverage at low prices or with greater flexibility. Though this option is not for everyone, it could reduce the cost of coverage for small businesses willing to take on that challenge. While self-funding has traditionally been more common among larger employers than small ones, there is growing interest in this method of insurance. However, it's still unclear just how many companies have already self-insured in response to the law or are planning to do so. With the opportunity to minimize risk but still offer comprehensive coverage, small entities have expressed an interest in learning more about self-insuring. Today's hearing will allow us to learn more about how self-insurance works for small firms and what factors they must consider before deciding to move in this direction. We'll also hear from witnesses about the benefits and pitfalls of self-funding for employers and what role health reform plays in these decisions. While this option holds promise for small firms, experts have indicated it could prevent much-needed consumer protections from applying to workers in small entities. For that reason, we'll also discuss how self-insurance could affect these companies' hardworking employees. As we examine this very important insurance alternative, we're looking for feedback to see how it will impact small employers and how we can ensure a broad range of insurance vehicles. I thank all of the witnesses for being here today, and I look forward to your comments. Thank you, and I yield back.
Thank you. To begin with, if committee members do have an opening statement, I ask that they be submitted for the record. And I'd like to take a moment to explain the timing lights that are in front of you. You each have 5 minutes to deliver your testimony. The light starts out as green. When you have 1 minute remaining, the light turns yellow. And finally, at the end of your 5 minutes, it will turn red. I'd ask that you try, as you can, to adhere to that time limit. Our first witness today is Michael Ferguson, President and CEO of the Self-Insurance Institute of America. Welcome. He has been with the association for more than 18 years, and in his current role, he provides executive management leadership as well as serving as the federal lobbyist for the association. Mr. Ferguson has significant expertise on self-insurance matters related to group health plans, workers' compensation programs, and captive insurance companies, and operates his own blog, which includes original reporting and commentary regarding legislative or regulatory developments affecting the self-insurance industry. Prior to joining SIIA, he was a corporate communications specialist for Rockwell International at the company's world headquarters. Mr. Ferguson earned his bachelor's degree in political science from California State University, Long Beach. Thank you for being here, Mr. Ferguson.
Well, good morning, Chairman Collins, Ranking Member Hahn, members of the committee. I'm pleased to have an invitation to come and join you this morning. I think this is a very important and timely topic, and I'm hoping to add some value to the hearing today. The couple areas that I'm going to hit on in my oral comments today is talk briefly about what self-insurance is and how it differs from traditional insurance, who self-insures, the ACA and self-insurance trends, the advantages and disadvantages of self-insurance, and talk about the federal regulation of self-insured plans. So the trick will be to do that with all of them in 5 minutes. So let me get right into it. Real briefly here, if you're to talk about the differentials between self-insurance and fully insured, if you're a employer and you want to provide group coverage to your employees, you really have one of two options. You can do a traditional insurance plan where you pay a premium to an insurance carrier, and that carrier, in exchange for a premium, basically takes the risk and provides coverage to your employees. The alternative is, as an employer, you can say, well, instead of paying an insurance company to provide coverage for my workforce, I'm going to self-insure. In other words, I'm going to pay the claims out of my own operating expenses or a trust that I set up to pay the claims. So instead of transferring that obligation to an insurance company, the self-insured organization basically takes that obligation onto itself and pays the claims as they are incurred. So that's the differential between the fully insured and the self-insured environment. Chairman Collins had already thrown out some statistics in terms of the prevalence of self-insurance. Just to pick up on that is of particular relevance to this committee. About 16% of smaller businesses self-insure. That would be defined within sort of the 3 to 200 band that is reported by the Kaiser Family Foundation. But what I think would be interesting for this committee to also add, although this is the purview of the small business community, self-insurance is not simply a business strategy that the private sector implements. Self-insurance is also very prevalent within many labor plans, self-insured Taft-Hartley plans that self-insure smaller groups, as well as many public sector entities, municipalities, many of which are self-insured. Collectively, it's estimated about 100 million Americans receive their health benefits through various forms of self-insured plans. So the self-insurance market is kind of a underreported business story, but it's pretty significant, and it spans, again, both private sector as well as the labor plans, and a third area is municipalities. So it's a fairly big marketplace, and so your hearing today is particularly relevant. So now that we've talked about a little bit about what self-insurance is, who self-insures, I want to go ahead and address one of the questions that has sort of been raised by the committee. Is obviously we're here because in the context of the Affordable Care Act, what does that mean for self-insurance? Is that influencing companies to self-insure? If so, why that is? Now, it's interesting, last year or two, you hear a lot of public comments that self-insurance is somehow a loophole to the ACA, or this is a way to bypass the requirements under the Affordable Care Act. And as my testimony is going to demonstrate, and hopefully we can get into some Q&A, I actually think that is an incorrect observation of the marketplace. And what you actually see is companies that self-insure actually subject themselves to more regulation collectively, not less, than if they were in a fully insured environment. And we'll get into some of that. So the question is, well, why are companies looking at self-insurance if it's not for some regulatory motivation? Well, I think the answer, if you talk to companies, is that particularly in this environment where there's some uncertainty in the marketplace, there is cost fluctuations that have been at least indirectly influenced by the health care law, what you find is companies that are migrating to self-insurance, they want to take more control of their costs. They don't want to be subject to an insurance company or a government entity dictating to them what my costs are going to be, what coverages I'm going to have. And so by self-insuring, you're able to take more control over your plan to the extent that you've decided that you want to provide benefits to your workers. A self-insured arrangement puts you in the driver's seat. You're the one that controls your plan going forward. And certainly there's some work to go that we'll talk about in terms of managing the plan. But basically it's control. It's ownership of your plan, which self-insurance provides. So that's, I think, would be our observation of what is driving that. There are several disadvantages to self-insurance. I would say that not everybody is cut out for self-insurance. There's a lot of financial and regulatory requirements that you have to adhere to, which is detailed in my testimony. But there's also several advantages being self-insured. So you can better manage your plan, cost savings, and a variety of other things that make self-insurance advantage. Again, not the right choice for all organizations, but it is a choice for some. So with that, I'll go ahead, and time is short here. I'll go conclude my testimony, and would look forward to answering questions from the committee as they arise. Thank you.
Yeah, no, thank you. And we will, try to cover a lot of these issues. The intent today is really to be informative to small business as they're in what we call the traditional sign-up period right about now, trying to figure out what they're going to do the first of the year. Our next witness is Robin Frick, who's responsible for key account management, compliance, and corporate operations with Combined Benefits Administrators, an enrollment firm and third-party administrator, or TPA, that performs insurance carrier billing, claims advocacy, and benefits management, located in Madisonville, Louisiana. Robin is testifying on behalf of the National Association of Health Underwriters. She's an active member of the organization for several years and has served on the boards of both the local New Orleans chapter and the Louisiana state chapter in several different positions. In 2011, she was accepted onto the National AHU Legislative Council, which provides legislative advice, communication, and policy positions to the membership, Congress, and the administration. Robin received her associate's degree from Emory University in Atlanta, her bachelor's degree from Louisiana State University, and is certified in transplant contract management. Thank you for being here. You can begin your testimony.
Good morning, and thank you. My name is Robin Frick, and I am a licensed professional health insurance agent from Slidell, Louisiana. I would like to thank the committee for inviting me here today to talk about self-funding health benefit plans and whether it is an appropriate option for smaller employers. I have been in the insurance industry since 1999, and I have spent my career helping businesses design and implement self-funded benefit plans for their employees. I've also been a part of my professional association, NAHU, for 14 years, and I am speaking on behalf of all of our members who work on a daily basis to help millions of individuals and employers with their health coverage needs. Regarding today's discussion of self-insurance, health benefits, and the small employer, I will be frank that the decision to self-fund coverage should not be taken lightly. It is a multi-year commitment in which the employer assumes the financial risk for providing medical insurance to its employees and their families rather than paying an insurer to bear the risk. The appropriateness of a self-funding arrangement is not only determined by the size of the employer, but also the financial stability of the employer, his or her risk tolerance, and the ability to administer a compliant plan. There is an increased interest by smaller employers in self-funding since the passage of healthcare reform, but this is a trend seen time and again at the state level when there are market reforms. The outcome of small employers self-funding, though, as a result of market reform measures, is still rare. Self-funding and stop-loss is not a new phenomenon. It has been around long since the days of cargo ships sailing to the New World. This new awareness of self-funding and stop-loss marketplace stems from the employer anxiety about changes to the new healthcare law that may bring to their employee benefit offerings, such as the new national health insurance tax, the Cadillac tax, and the changes to premium rate calculations. Self-funding a health plan provides a means to structure benefits to meet the specific needs of an employer, but does not allow employers to escape the impact of healthcare reform. Most of the reform law's market protections apply to employer groups of all sizes, regardless of how they are financed. For example, a safety compliance client with 75 employees in good health and stable age gender demographic is interested in alternate funding, such as self-funding with reinsurance, in lieu of paying an increase over increase each year into a fully insured insurance policy without experiencing the large ongoing claims that would normally directly impact the rates. He is experiencing a significant increase each year that is not indicative of his employee population. On the other hand, an electrical contractor of 50 employees that has ongoing health, both medical and prescription drug claims, each year would not be able to financially support a benefit plan in a self-funded arrangement. His company may be in a healthy financial position now, but if we extrapolate the expected risk 2, 3, and 5 years out, he will very much risk losing what he has worked so hard to grow. He would pass on the assumption of risk. I have experienced quite the opposite, too. A bank client of 170 employees is considering the transition to fully insured from self-funding with reinsurance, as they can no longer sustain the adverse claims. The impact over the last 3 years has significantly depleted any reserves previously realized and gained through their self-funded arrangement. And the concern is that they are behind the 8 ball, so to speak, and they cannot get ahead. They are tired of assuming that all of the financial risk, the administrative responsibilities, and the compliance liabilities. The growing interest of alternative funding mechanisms has led some self-funded marketplace innovation with the development of hybrid-level funding plans, which can ease the transition from fully insured to self-funding. And we anticipate further growth and innovation within this regard. From a compliance and regulatory perspective, although self-funded plans fall outside of state-level insurance regulation, though they have always been subject to ERISA, stop-loss policies are actively regulated by state insurance departments and are held legally accountable for marketplace conduct, likewise for the licensed insurance professionals advising in those arenas. In short, as healthcare reform has moved forward, employers are looking to gain greater control over their employee benefit options and funding mechanisms. I truly appreciate the opportunity to provide testimony to your committee today. I consider it a huge honor to be here and a privilege to be able to inform you, our elected representatives, how the self-funded health insurance marketplace works for employers both large and small. Thank you.
Thank you very much. Up next is Thomas Faria. Is that correct? Faria, President and CEO of Sheffield Pharmaceuticals in New London, Connecticut. He has been President and CEO of Sheffield, one of the nation's fastest growing contract manufacturers of over-the-counter pharmaceutical creams, ointments, and toothpastes since 2002. In this role, he's responsible for overseeing all areas of operation of a 160-employee, $30 million pharmaceutical products manufacturing company. The responsibility includes the absolute authority on all major decisions that affect the company, and he acts as the public voice in all legal, public, and customer relations. Mr. Faria received his B.S. in Industrial and Operations Engineering from the University of Michigan and his MBA from Bryant University in Smithfield, Rhode Island. We appreciate your participation, Mr. Faria, and please begin your testimony.
First of all, I'd like to thank you for the opportunity to speak to you all. I think this is truly a very important topic to talk about, especially for small businesses, because as you review information in terms of some of the topics that are most important to small businesses, what usually rises to the top is the ever-increasing costs and the unknown costs of the future of providing health care for their employees. Our experience that got us in Sheffield to try self-insurance, it really started in 2007. Up until that point, every year we would go through and review our health care costs and quote them, and we'd expect a moderate increase of 5 to 10% on our insurance premiums. In 2007, we had a few unfortunate events with our employees they were using that caused our health care costs to go up. In response to that, our fully insured provider increased our rates 25%. The next year, they were looking to increase our rates 39%. And when we looked around for any comparable products from their competitors, they were even higher. So at that point, we took a look at and really did a leap of faith, knowing that our staff were both fairly young and fairly healthy. We went for the opportunity to self-insure ourselves, and we've been doing that since 2009. What I can say is, so far, that's been a great decision. We have saved over that 4-year period roughly $400,000 compared to what we would have paid for our insurance premiums, and that's about a 19% savings. What we did with that savings, really, that allowed us to keep our benefits the same. We have a gold quality insurance program, and we've kept that affordable for our employees. When I look at some of the benefits that self-insurance can help with small business, first, obviously, there's an opportunity to save costs. Secondly, whenever you give an entrepreneur or a business the opportunity and the information that's provided, you give them an opportunity to get responsible for those costs and accountable for those costs. And so self-insurance allows for some transparency on the health care costs that these businesses are incurring. This allows them to cater, and self-insurance allows for the flexibility to change their plans pretty much on the fly to adjust their plans for efficiency and also, in some cases, to reduce costs. What self-insurance also does, it allows and gives great incentive for small businesses to invest now in education and incentives that help improve overall efficiency of their programs. As a businessman, I can say that such investments usually would not, you wouldn't go and invest in such incentives when the benefit may turn out to be your fully insured provider. Here we're looking at mitigating future costs by providing incentives for people to first go out and get physicals yearly, and also we provide incentives for them to lead healthy lives. That means checking your cholesterol, blood pressure, not smoking, keeping a healthy weight. And it's truly the self-insurance plans that allows us the flexibility to really kind of cater our programs to the needs that we see in our employees and also that we see coming up through the data that we are reviewing. I thank you and look forward to contributing in any way. Look forward to your questions. Thank you.
Thank you very much. I'd like to now yield to Ranking Member Hahn for introduction of our next witness.
Thank you, Mr. Chairman. It's my pleasure to introduce Dr. Linda Bloomberg. Dr. Bloomberg is a senior fellow at the Urban Institute's Health Policy Center. Her recent work includes a variety of projects related to the analysis of health reform and state implementation of the Affordable Care Act. Dr. Bloomberg serves as a senior advisor for the Institute's Health Insurance Policy Simulation Model and is also a member of the Health Affairs Editorial Board. Welcome, Dr. Bloomberg.
Thank you very much. Mr. Chairman, Ranking Member Hahn, and members of the committee, I appreciate the opportunity to testify before you today. The views that I express are my own and should not be attributed to the Urban Institute or its sponsors. My testimony draws on my own and my colleagues' analyses of the ACA, some of which rely on a 10-state case study effort of ACA implementation, which the Urban Institute continues, along with our colleagues at the Georgetown University Center for Health Insurance Reforms, and some of which relies on the Urban Institute's Health Insurance Policy Simulation Model, HIPSM, a microsimulation model that estimates individual and employer responses to specific provisions of the law. Our analyses lead to the following main conclusions. Changes to small group insurance under the ACA intended to broaden sharing of health care risk across firms and increase premium stability and access to insurance do not in general apply to self-insuring firms, regardless of size, nor do they apply to private stop-loss policies, the product that makes it feasible for small firms to self-insure. As a result, small, young, and healthy firms will have increased incentives to self-insure once the ACA's reforms are fully in place, possibly trying to move between self-insurance in healthy years and fully insured products in less healthy ones. However, stop-loss policies combined with the self-insurance approach itself carry substantial financial and legal risks for small employers. As such, sales of stop-loss to small firms are relatively uncommon today. In fact, many sources in our case study work from the insurance and producer communities felt it was irresponsible to market stop-loss policies to small firms. However, we are seeing increasing marketing activity by reinsurers since passage of the ACA, including the emergence of bundled products, which combine stop-loss coverage with administrative services. Many traditional insurers report that they do not want to get into this business, but if they see their traditional products being undermined, they will have to participate as well. While some states, for example, Colorado and Rhode Island in 2013, continue to pass laws due to the risks involved, in the vast majority of states, stop-loss coverage is not regulated like insurance, and as such, the policies can be denied to small firms outright due to their health status, are not required to cover specific benefits, are not guaranteed renewable, and can charge premiums based upon the claims experience of a particular firm, with re-underwriting occurring frequently. Reinsurers can also include lasers that exclude coverage for the expenses of a group's highest cost or highest risk members. Stop-loss policies may not pay claims until the end of the first quarter after the plan year ends, leaving small, financially vulnerable firms to pay all incurred claims up front. Small employers may be wholly financially responsible for claims incurred in a plan year but filed after the end of that year once a reinsurance policy ends, leaving the employer exposed for large dollar amounts not anticipated. Significant increases in self-insurance also pose substantial risks to those small firms wishing to remain in the fully insured market, an issue that has led some states to prohibit the sale of stop-loss to small firms. And due to these risks, in 2012, an actuarial subgroup of the NAIC recommended changes to their model law, which would set the attachment point or deductible for stop-loss coverage at a minimum of $60,000 per insured individual. Our microsimulation analysis finds that their suggested parameters would in fact dissuade the vast majority of small firms from self-insuring. Under this approach, average premiums in the fully insured small group market would be lower than under a scenario with looser stop-loss regulations or none at all. If these recommendations were implemented in a uniform manner nationally, the fully insured small group market would be roughly 1.5 times as large, and the average fully insured small group premium would be 20 to 25% lower than if reinsurance effectively acts as unregulated insurance. To conclude, self-insurance and unregulated stop-loss coverage carry substantial risks for small employers who are often already financially vulnerable and frequently ill-equipped to take on the additional financial and legal risks associated with it. It also carries risks of undermining the ability of other small firms to purchase affordable coverage for their workers in the fully insured market. A majority of states do not regulate the sale of stop-loss insurance today, and many of those that do regulate it require minimum attachment points well below recent actuarial recommendations. In addition, we were unable to identify even a single state that currently monitors the sales of these policies to small firms, and only one that has plans to begin doing so. The federal government could intervene, prohibiting the sale of stop-loss insurance to small employers, requiring its sale to small employers be regulated by small group rules, or setting minimum attachment points consistent with the new recommendations. At a very minimum, the federal government can develop and implement an effective plan for closely monitoring increases in small firm self-insurance nationally and by state. Given the magnitude of other tasks and time pressures, states are not inclined to do so on their own, which means that in the absence of a concerted federal effort, states will be unprepared to intervene as warning signs increase, the time at which major market disruptions could more easily be avoided. I'm happy to answer any questions that you might have.
Thank you to all the witnesses. I think we can have some very interesting questions. Ms. Hahn and I tend to run our hearings a little different than most. Instead of going first, which you find with many chairmen and ranking members, we like to go last. Our fellow members have busy schedules, and so I will defer, as she will, to our fellow members here, and then we'll bring up the rear. So with that, I'd like to start with the Congressman from Colorado, Mr. Kaufman, if you'd like to ask some questions.
Thank you, Mr. Chairman. I think this is, certainly having been a former small business owner, that this is a very important hearing, given all the changes to health insurance in America right now under the Affordable Care Act, better known as Obamacare. And I'd like to ask each of the panelists if you could answer relatively quickly, but to basically say, under the pressures of the Affordable Care Act, do you think that self-insurance will grow in this new environment, and as a mechanism for small businesses to afford health insurance for their employees? Start with you, Mr. Ferguson.
Sure. Thank you, Congressman, for the question. To answer that, I think our view would be that we would predict a continued growth in the marketplace, although that growth will probably be somewhat moderate, just because, for reasons that some of us have talked about already, is stipulated self-insurance is not the best choice for all companies, particularly small employers. For some, it's a great choice. But what we're seeing in the marketplace, there's a lot of companies that are looking more at self-insurance, and as part of that process to evaluate whether that choice is right for them, many of them, as they sort of go through the process, realize, well, this may not be the right choice for us, so they don't go forward with that. But for companies that they have the financial viability, they have the sophistication to pursue this funding method, it is a good choice. So for that reason, since there's more interest generally, I think you are going to see a continued growth, but again, I don't see it as a wholesale migration. I think you're just going to see more companies gradually shift into the self-insurance marketplace.
Thank you. Ms. Frick?
I agree with Mr. Ferguson. I don't know that it would actually explode as far as all of a sudden a vast rush of people to come in to self-fund. The growing interest doesn't necessarily equate to a growing number of new self-insurance or stop-loss policies. Just as Mr. Ferguson indicated, you will have more people that are looking into it, doing the math, and as insurance professionals, that's our job, to help them determine the risks and advantages of every kind of funding mechanism available to them. So the increased interest is in something that's now newer to them than it has been before, or rather may be available to them than it has been before. You still see reinsurance carriers that would provide the stop loss behind it, still somewhat a little hesitant to come down into the market of under 100 or under 50, just because that market space is typically not very self-funded friendly from a risk standpoint.
Mr. Faria.
I guess my answer would be I hope so. But I belong to an organization called the Young Presidents Organization, and in that organization, we've had numerous talks about self-insurance, and actually, literally, one of the topics was about how to respond to Obamacare, and they were actually pointing towards self-insurance as a way to potentially mitigate the unknown costs that Obamacare may cause in terms of increased fully insured premiums. I think right now, especially right now, when you're looking at a situation where the fully insured providers have an unknown, certainly with this website problem and other issues, and of course with the issue here with people losing their coverage, they're not quite sure how they're going, what the premiums are going to be going forward. And I think right now self-insurance might be a great option for some people to mitigate that potential liability of increased fully insured plan premiums.
Thank you. Dr. Blumberg.
Because under the Affordable Care Act, price discrimination based on health status of a small group is prohibited nationally for the first time, the self-insurance becomes a more attractive option for firms that have more healthier than average risks in their firm. And so we do expect there to be an increase in self-insurance as a consequence, barring other intervention, either federally or at the state level. I will mention, too, that in terms of the uncertainty that one of the witnesses was mentioning, the issues with the website really are very strongly unrelated to the vast majority of the small group insurance market, which will continue to, in the fully insured market, buy through brokers and agents as they have in the past, with some percentage going through the exchange. But the markets are merged between the exchange and the non-exchange small group market. And so anything that affects creates a segmentation of risk between the self-insuring firms and the fully insured firms affects the entire small group market.
Thank you. Thank you, Mr. Chairman. I yield back.
Thank you. At this point, we'd like to yield 5 minutes to the Congressman from Oregon, Mr. Schrader.
Thank you, Mr. Chairman, and I appreciate the tone of the hearing, if I may say so. It's a great idea, a great topic. I'm curious myself to see how this may or may not work out for businessmen and women around the country, so I really appreciate it. First, I guess, to Mr. Ferguson, if you could elaborate why you don't think this is a loophole in the ACA, and then you first comment on how this stop loss works. It seems to me, a small business to me is something under 50 employees. And you're one catastrophic event away from losing your business if you don't have big cash reserves. How does that stop loss really work? I'd ask Ms. Frick the same question in a minute. But why is it not a loophole, and why is this remotely possible for small business?
Sure, I'm glad you asked that question. So let's explore actually both of those variations. The issue about the loophole is that there's concern or express stating that somehow self-insured plans are these unregulated entities that are out there and are sort of operating, kind of the Wild West. But in fact is, if you put a finer point on it, what we're really looking at in this discussion is what's the trend? Employers that are moving to self-insurance post-ACA. And by definition, those plans would be non-grandfathered self-insured plans. We've got two varieties, the grandfathered and the non-grandfathered self-insured plans. So all of those plans that are moving to self-insurance would be non-grandfathered plans. And as such, they're subject to almost all of the regulations under the ACA. There's about 3 or 4 that they're not subject to, and there's particular reasons why they're not applicable to self-insurance, because essentially self-insurance they're the equivalent of nonprofit health plans. They're not in the health insurance business. They're widget manufacturers. And so in addition to that, not only are they regulated by the ACA, they also are regulated by ERISA, also HIPAA, COBRA. There's all these other federal laws that apply. So if you're going self-insured, you're actually subjecting yourself to more regulation, not less, if you're looking from a business owner standpoint. Now, to your question about stop-loss insurance, distinction between stop-loss insurance and health insurance. Stop-loss insurance is essentially a liability type of insurance product between the carrier and the employer. A stop-loss insurance policy does not cover individuals. It doesn't pay claims. And so there's a distinction that you need to keep in mind whereby you've got the plan, the self-funded plan, and you have the participants within that plan. And those participants are in the plan. They get coverage under the plan no matter what the stop-loss insurance arrangements are. The stop-loss arrangement is simply a reimbursement mechanism between the employer and the carrier. So the fact any of the arrangements of the stop-loss does not affect the plan participants, whether there's a laser, which means that the employer retains liability for one or more people under the plan not subject to liability. It's simply a reimbursement mechanism. So that is a financial tool that the employer uses, and it really has nothing to do with the health care per se delivery for the plan participants. I hope that addressed your question.
And then, Ms. Frick, if you'll chime in. So what does it cost? I mean, if you're willing, if the stop-loss companies are willing to assume that ultimate risk, I've got only so much cash, my employee develops cancer, has this catastrophic crippling injury, I don't have enough money to pay that. That's the reason I got you as a stop-loss and insurer or backstop. What does it cost me to have you do that, and what caveats do stop-loss companies put in to make sure they are not on the hook?
Sure, very good question. So in a stop-loss arrangement, self-funding, either you're going to assume everything without the backstop of reinsurance, or you purchase reinsurance, just as you said, to cover your more catastrophic risk. So rates are determined just as you would in a fully insured market from the reinsurance, but without the medical piece. The medical piece is added in after when you're looking at your specific medical claims experience and how you can trend that forward for your expected and then a maximum liability over that next plan year. So in the reinsurance piece, you're still taking into consideration the size of the group, the demographics, the area factors, where it is, and just the cost of what you're needing to cover. And then of how large of a deductible do you want on each belly button that's covered in the plan. And then if you are in that size market of, say, 1,000 or less, you're going to want the extra aggregate protection that protects collectively all of the belly buttons in the plan. So you have one on each and then one as the whole. So in that perspective, there's always, you have to take all of that in to develop some kind of fixed premium cost that's a known factor over the 12 months. Your claims, you do trend out and expect where they'll be. It's safe to put a corridor so you have a maximum liability to what you maximum would pay out, say about 125% of where you expect your claims will fall. But the reinsurance provides, if I set a deductible on each belly button as $10,000, then after that $10,000, my plan is reimbursed by the reinsurance carrier for anything over that expectation. So there's a cost factor. They're looking, the reinsurance carriers looking at everything, looking at the claims experience, what has happened before. Now, what's interesting is if you're moving in typically that small group market under 100, you don't get the claims experience. Or if you do, it's very aggregated. It's not very specific, as we have known in the past. So now it's not a guessing game, but you're looking at a whole market or a pool in and of itself. So now you're having to determine across a broad spectrum, what do I believe for this area, for this type of industry, for these kind of workers, where should we place the deductible level, what do we expect out of them? An oil rigger is going to have a much higher risk factor than someone who sits behind a desk every day. So those are all taken into consideration. But the reinsurance does provide sleep insurance. I know at night that my total exposure is X. I know if I have an aggregate coverage that my total as a plan is X, and now there are reimbursables. As was noted earlier about, just totally crippling someone, it does just help to have that something in the background.
Sure. Thank you very much, Mr. Chairman. I yield back. Very helpful.
Thank you. At this point, we'd like to yield 5 minutes to the Congressman from Kansas, Mr. Huelskamp.
Thank you, Mr. Chairman. I appreciate the opportunity to visit here and learn much more about this topic. And my first question would be for Ms. Frick, and thank you for being here. How many years of background do you have in this industry and your education that qualifies you for your current position?
Sure. So I've been in the industry ever since I graduated from college, basically. So a little over 14
2
years.
years ago? Okay.
Yeah, about 5. Okay. Thanks. And I have been active just from the perspective when I started my career, I started out with an insurance consulting firm, and just started asking a lot of questions and moved from the small group space and fully insured into our client size was into the middle market space, starting to get a mix of self-funding and then to a larger self-funded market space. I was curious. I asked a lot of questions. I like to learn it, and if I need to educate you about it, I need to know what I'm talking about. I worked with a managed care company for a year, so I had a very interesting and in-depth look on the inside from how an HMO itself functions. I had a very good relationship with the underwriting actuarial department, so now I really understand how rates are calculated. What is the value of a copay? What is the value of the deductible and out-of-pocket? And then from then back on the consulting side.
And last week in a hearing, for instance, the HHS secretary did admit a felon could serve as a navigator potentially. How comfortable would you be to call up a navigator or visit with them in order to make your health care decisions?
Honestly,
Yes.
Not comfortable at all. Unless I knew that they were a licensed, regulated entity that had to conform to continuing education, as we have to a required number of hours every 2 years, and we are subject to market conduct and are held legally accountable for what we do, what we say. We carry E&O insurance. We have, for any claim against us. I want to know that the person I'm talking to on the other line knows exactly what I'm talking about or asking the questions for. I appreciate if someone doesn't know and is honest and say, I don't have that answer, but I'll find out for you. But I would much rather, if I'm making a big healthcare decision, just as an employer, as an individual, this is your number 2 for an employer payroll. This is the number 2 list on your accounting statement. You've got to know who you're talking to and who you're dealing with, and they are going to be able to be objective in helping you determine what's best for you.
Okay, well, thank you. I share that concern as well, hearing that from constituents worried about instead of the agent they usually rely on or the folks that help manage their account at their employer, just worried about a navigator, untrained, perhaps for a month, not even that, no E&O insurance. I hadn't even thought about that. I mean, that's just a basic requirement for the agents. The second question would be for, I believe, for Mr. Ferguson. I'm looking at a story from my district in Kansas, Salina, which is about the middle of the country, and a company by the name of Vortex Corporation. They worked really hard. Their insurance renewal date was just happened to be July 1st. And they worked really hard and made that requirement, did everything they needed to do, and then shortly thereafter, the administration announced, you know what, we're just going to ignore the portion of Obamacare that says the business mandate. We're going to put that off. So, other companies, were they in this situation? And what's been the impact of delaying that? I've heard various reports of what that has meant for businesses, and if you could provide some light on that, Mr. Ferguson.
Well, I assume you're referencing companies that currently maintain a plan and are determining whether to continue that plan through 2014. Is that the direction?
Yes, in this case, the renewal was July 1st.
Right.
And they worked everything they could in the law, and all of a sudden it was suspended for a year or whatever.
Yeah. Well, what I can simply tell you is anecdotal, so disclaimer there, and the companies that I've spoken with is that all of the companies that provide or are thinking of providing a group health plan, they've run the numbers, so to speak. They've done the analysis in terms of whether they want to start a plan or maintain a plan, and they've probably reached some initial conclusions as to whether they want to play or pay. But most of those companies are taking a wait-and-see attitude, particularly the ones that are thinking about that they might drop the coverage and go ahead and pay, because they're kind of waiting to see what exactly how is the experience in the exchanges going to be. For instance, for companies that would be considering potentially dropping their coverage, one of the things that they're looking at is, okay, are the exchanges, are they going to be functional? Are they going to be effective? Because that's going to impact the decision of the employer. If they're thinking, well, if my assumption is that I could drop my coverage and there's a viable option for my employees, and it's easy, and you can get your affordable coverage as the law anticipated through the exchanges, that might influence my decision to go ahead and drop my plan. On the other hand, if there is uncertainty in the marketplace and the exchanges are not delivering on that promise, then that would sort of push them back to maintaining the plans. I think if you talk to most companies that are self-insured, that have run successful self-insured programs, their preference is to keep their plans, just because for no other reason it's a It's a value to them. It's a value to retain and attract talent. So for those successful plans, they're inclined to keep them. But they've all run the numbers. They've all had their initial analysis. Most of them, if not all, will not publicly state what their intentions are. But in some back room, they have a spreadsheet that shows all the different variations. And again, as I said, a lot of them are just sort of waiting to see how. Obviously, there's a lot of uncertainty that's going on in the marketplace right now. So they're kind of waiting to see how this all plays out.
All right. Thank you, Mr. Chairman.
Thank you. At this point, we'd like to yield 5 minutes to the Congressman from Missouri, Mr. Lugelmeyer.
Thank you, Mr. Chairman. Just a couple of quick questions here. Mr. Ferrier, you have a plan in place and have been working with it for how long now?
We've been working with it